what am I going to cover today, right? Briefly, looking at as an entrepreneur. So I'd like to set the context of the whole finance as part of your entrepreneurial journey, and just going back to the basics there, saying why are you in entrepreneurship? Look at the various elements of finance and math in the business. So I like to call it math because really it is about numbers, right? Basic arithmetic, rather, I should say, key arithmetic elements, right? It's so simple. It's like your, early stage school maths, 5th, 6th, 7th, 8th standard kind of numbers, which we talk about. How do you look at them from a business point of view? And then, of course, looking at it very strategically from a financial model perspective, how do you smartly build a financial model, factoring your constraints at any point in time, and also quickly, redo your planning if your mode of pricing or your strategy in finance is not working. Then looking at, of course, funding. This is something I'm doing for today's session. A focus on funding, because I think if you're looking at a slightly evolved business which has come down, and sustained and survived, then typically one starts looking for the next stage of growth, which means you need money. So do you get the money from yourself? Do you borrow the money? Do you get it from an investor? So those nuances of fundraising, and typically from an investor, the focus is going to be from an investor funding, because I think that is where the gap in the knowledge is. Borrowing, one understands typically, pretty much people do understand how to get money from a bank. I mean, what's the process, at least on paper. Then we come to measuring and monitoring your business, because how do you know your business succeeds? It's not just by somebody telling you you're doing great or you're finding a new customer. Overall, how do you measure? And then, of course, the concluding points and Q&A. So, yes. So why are we looking at the math, right? And this is something I emphasize, and those who heard me before will know that I talk of finance as the language of business, right? So just like you need to communicate, whether it's to communicate to yourself internally, to your team, to your stakeholders, to the environment outside, investors, you need to have something to communicate. And in this business of entrepreneurship, and in a business environment, the math and the accounts and finance are what people look at first, right? In addition to looking, of course, at customers and competition, they look at your numbers to understand where you're going and whether you're succeeding. So it's an output which measures where you are at a point in time and helps you in decision making and understand if your business is healthy or needs to be retweaked, etc. So as you start, like I said, the whole context of finance is about understanding where you are and where you want to go. So just recap, and what I like to say is my sessions, my presentations are more like notes for you to take away from the long term. Yes, you sit through my presentation in the session, but I also like you to look at some of these. For example, these questions: what is your dream? Do you want to be the best, largest, etc.? And the next slide will tell you about what is your ask you what is your motivation. I don't expect you to answer now, but as an entrepreneur, I think it will be very useful for you to periodically go back to this, right? Because are you motivated by making money? Are you motivated by fame? Are you just wanting to make an impact? And especially the ones who set up social businesses, right? So you want to make a difference in lives of others. What is it you want to do? So it's good to periodically go back to this and then, come back to your area, which is the finance or your sales or customers, and see, is that what you're doing fitting into your motivation or your dream, or do you have to reset, right? So this is the guiding post. So now let's look at the financial elements, right? So these are 4 elements I talk about. I've distilled it into these 4 as critical elements. Revenue, of course, one understands revenue, right? Or you think you understand revenue. And then there is costs, right? And how do you actually earn the revenue by spending money and operating, right? When you run your operations, when you run your marketing, when you run your administration, you incur costs. So are those costs in sync with the revenue? Or are you making much less than you spend? So the classic example is the e-commerce companies. Now, if you look at it, let's take Flipkart, which everybody has interacted with. Probably almost everybody here would have interacted with the Flipkart platform at some point, right, for purchase or in some other context. So when you look at Flipkart, what is it? What do you think of? Do you think of it probably as a successful business and where you can buy from, and they've been successful because they have sold out. The entrepreneurs have done very well for themselves. So that's from the entrepreneur point of view. But as a business, if you just stop to think, um, do you think Flipkart has made money out of it? Is it profitable? It is still somewhere in the future, right? People assume that it will now at some point make money because it has the big Walmart behind it, and there is a big need in India, and especially in today's world, right, with everything wanting people wanting to go online, with the various issues which bother us post COVID. So you may think it's profitable, but actually, are the costs commensurate with the revenue? No, right? The costs are significantly higher, and it looks far away. So I'd like you to just think about it. So this is what finance and accounting is also. You are different from the business. So here the entrepreneurs who founded Flipkart have been successful, but the business model of Flipkart, it has not yet shown its success, right? It has yet to. There is hope, but one has to wait and see, right? And the same thing happened. I'm using big names here because everybody can relate to it. If you look at Google or you look at Facebook, right? Originally, when they started off, they were not profitable. They were draining a lot of money. But subsequently, down the line, they turned profitable. They started getting money from, their advertisements, right? So we have to see in Flipkart if they can come out with a model where they get money. So if you look at Amazon, for example, which is the other big e-commerce company, right? The founding one, you could say, globally, one of the big ones. So in the case of Amazon, while e-commerce is making money, the bigger chunk of money comes from their cloud service. So actually, that's where they're getting a lot of. It's like a cash cow is the word which is used, because they're generating a lot of money through the cloud AWS, which they're hosting, right? So you really need to look at from your business, okay, coming down to earth now. These are names, big names, right? They've made it, they're out there, and some form of success, whether it's entrepreneur success in Flipkart or the business success in the other big companies, right? And you can think of so many other names. So in your business, where do you want to go? So if you're looking at a model like, say, a Flipkart, where you're saying, okay, I'm building this product, I'm going to lose, it's okay if I lose money, but maybe tomorrow a Google or a Tata's, right? Mahindras will buy me because I'm working in the auto space, right? Or I'm in the financial space and an HDFC or Kotak Mahindra will buy me out, right? It doesn't matter if I don't make money, but I'm going to sell out and make money. That's okay. That's your business model. So you need to think about it very carefully, because if you're at the stage today, I don't know how old your businesses are. Some of you may be 2 years old, some of you may be 5 years old. So you need to think about your dream and how do you achieve that, right? How do you make yourself attractive to this XYZ company which is going to buy you, and which is where we come to the value part of it. So I'm skipping to the last point, saying, how do I make myself valuable to a big corporate for a strategic buyout, right? And there are ways to do this. Sometimes what happens is, I know a small company. In fact, they were incubated at IMB NSR cell. So what happened was this, finally they sold their IP to this large corporate multinational. So they started off doing some service jobs, And then the corporate, the multinational, picked up a small stake in them, and then their intellectual property was attractive, so the big multinational picked up their intellectual property. So there are different ways of doing this, so you need to think about these when you think of finance. So it's not just about numbers, it's about thinking strategically. And the last point, which I didn't talk about, is cash burn. That again is something you can think about strategically. What is cash burn? It's like some money that you burn is which is not going to come back, right? Like when you talk of Diwali, we burn the crackers, we light them up, and the money doesn't come back. It only goes away as smoke and pollutes, right? It need not be such a distress situation here. In the case of cash, it could be money which goes on a regular basis towards rental, towards your amenities, towards salary costs. So some of it is productive, some of it is not productive. But basically what we like to understand is what is the minimum money that you have to spend per month. And this can be again decided strategically. For example, if you take a big structure and rent out, and your rentals is in the order of say 25 lakhs a month, you're going to burn minimum of 25 lakhs plus the electricity charges, etc., right? Water, amenities, your bills, other bills, so maintenance, etc. That's going to be huge. Whereas if you work out of home or take some small space, limited space, right, and then your cash burn, that you save that not just 25 lakhs but much more per month. So you can think of working strategically, and that's where the financial model also comes into play. It's not just about the way you price, it's the way you build your business, right? And this may change with time. When you have less money, you try to conserve money, and it seems like common sense, but you build it into your financial model. So again, just quickly coming to this, customers and revenue are different. If you look at Gmail is the classic one which I talk about, Google, where you and I may be customers who don't pay, but if Google doesn't treat us well, we will not go back to it. So then they will not get enough advertisement, and so the advertisement revenue will stop or reduce. So they have to treat the non-paying customers very well, so that the paying customers pay and come back, right? So there is a distinction between customers who pay and customers who give revenue. So in your business, this is like a platform we talk of. Platforms have different kind of revenue streams and customer streams. And you need to look into your business and understand where are your customers coming from, and how do you keep them coming, and how do you keep your revenue streams coming. So which may not necessarily be the same. Spend a lot of time looking into that. And these are some of the product lines. So how you can get into it and analyze it is looking at your various product lines or your solutions, and look at the math there. So by now you must be having some data. Look at your past track record in the last few months, few years, quarter to quarter, and see where is the money coming from. So there was this restaurant business which had both fast food and restaurant offerings, and they analyzed incorrectly and assumed that the fast food was getting their money, whereas actually they were making money from the dine-in services. And so they tried to close down the dine-in, and they found they're bleeding much more money. So they quickly had to go back and reorganize. So this is where the math and the accounts help. If you structure your financial statements and accounts in such a way that you can analyze, right, your accounting structure. So speak to your service providers and finance professionals to say that you want to look at these. And some of these areas they may be able to help you with, because if they're not able to help you with this, then you may have to pull out the data and analyze it separately with a spreadsheet, which is very basic, or look at some other kind of tools which are available to analyze it. So when you build your accounts and finance, please do look at these critical areas. This particularly, the finance and revenue becomes, it's your lifeblood, right? So it becomes critical to look into this. And then of course, this is the way, you look at the sales volume. If you look at the customer segments, saying, how do I reach out to different customer segments? So if I'm targeting, I was talking about Gmail itself, right? How do they kind of make it interesting for people like you and me, as well as how do they make it interesting for advertisers? So what are the activities to reach out to the different customer segments? and how do they get revenue. Then the other aspect which I was talking about is your expenses. Look at the different account heads of expenses, right? Which is also for analysis. Just like I was talking to you about the analysis of revenue, you need to look at the analysis for the expenses. And expenses are typically looked at in two ways. We talk of capital, that is your big setup costs, right? As well as the revenue. Revenue expenses are usually the expenses which are incurred on your day-to-day operations, right? Which could be your salaries, it could be your rental costs, it could be any other tools that you use, right? Software tools, or your sales administration costs, right? And marketing costs. So those costs which you need to incur to make your business sustainable, to sell, to purchase. So if you are having producing something, you may have to buy stock, the raw material cost, the factory cost, if to run the machines, right? The any other raw material which you use, any chemicals you use, if that's required, etc., right? So just look into the various expenses, and now that you're in a next level of your business, just try to see where are the critical elements of expenditure coming from. So are you spending, for example, the airlines, right? If they're spending a lot on the fuel, so how do they kind of look into that? There was this company, and I mentioned it in my earlier session also, where it was operating out of a mall. And when it realized that the malls were going empty, it went back to the mall owner and renegotiated, saying, I will not pay you so much as rental. I will pay you a smaller amount, and I will pay you based on the sales I make. So this is strategically the costs were reduced, and only if they sold, for every 100 rupees they would pay some amount for rental. But if they didn't sell, so instead of 1,000 rupees, if they sold only say 100, so their rental costs were down. And at the same time, the mall owner also struggled renting out space. So they felt that in this way, instead of getting say a 25 or 30 lakhs rental, they could even get 40, 50 lakhs. So by increasing the sales. So these are some ways in which you look at your finances and expenses, trying to see if your financial model or your way of, getting the expenditure out and reduced, if there's something you can do there. And I know, of somebody in the Silicon Valley this was a few years ago, they even gave their landowner the rent, instead of paying rent, they gave equity stake, right? So whether, of course, if that's something you want to do or don't want to do, and I think it's quite common in the Indian context also, you do offer equity to advisors and consultants, right? Now, whether they take you up on it is a different matter. Some people do and some people don't accept it. And the other issue when you do such things, when you offer equity, especially in the Indian context, is the laws and the tax implications. So for example, a consultant, if the consultant has to take stake, they have to declare it as income and they will have to pay tax on it. So the tax on both sides and the regulatory aspects, so the laws of the land have to be understood by you. So while you're doing this, don't just look at the math of it, just look at the other legal and tax implications also. So it's important. Why am I spending time on this? This is the base, the foundation of your business. So spend some time, and when I come to MIS, I will talk about that again. Spend some time looking at these numbers and trying to see if you can be innovative in these, keeping the tax and the law in mind, and which is where you will have to get professional help, right? So you'll have, because for example, even I don't understand the finer nuances of tax and law. So if as an entrepreneur, I had to talk to my auditor and my lawyers to understand some things which I wanted to do, to make sure that it was fine and ultimately not counterproductive, because it was not if you want to give stake or equity, right, it has to be compliant with the law. So spend some time. And as entrepreneurs, and these are areas where entrepreneurs do not spend too much time, right? The focus is more on saying product and how wonderful my product is, right? What needs, there's a gap in the market, there's a need, and by giving this new product at a good price of great technology, that's only one part of it. This is the other foundation part of it. So spend some time on this also. Carve out some time. These thoughts cannot, thinking cannot be outsourced to your legal and accounting professional, finance professional. Some of these are to be creatively thought about by you, and then you validate it, right, with your professionals to see if it's compliant. And there's no other loss of money. So whatever money you save should not get lost in tax, either for you or the party on the other side. So spend some time on this. And the basic equations which you need to keep in mind is, this is very obvious, right? The profit is equal to the revenue minus the expenses. The question comes when you want to understand what is my expense, right? What is my unit cost? You try to work out. How do you decide on the expense? And this was a question which came up, and somebody else also had. If I produce, let's say, 1,000 units, okay, and versus if I produce 10,000 units, my costs per unit are very different, right? Because this is obvious that the same. You may have like say 5 people in the sales team, and if you look at it, when you're producing 1,000 versus 10,000, the cost, the same 5 people may be able to manage both, right? Or 5 may become 7. So the cost of 5 on 1,000 versus 7 on 10,000 is very different if you split it up. So the costs reduce, the per unit cost reduces. So when you're calculating your expense, this is when you're projecting, right? This historically, yes, you can go back to your numbers and understand where is the revenue, where is the expense. But as a startup, as an entrepreneur, you're looking at growth. So when you're looking at growing, you will like to project your numbers and look at what could be the costs per unit there, or overall costs for the business, and then you can work it out, right? So pricing also works, impacts, and costing is what I talked about now. So pricing is an art and a science, and it depends on how you offer your product or solution. You may offer to sell the unit outright, or you may offer it on installment basis, or you may offer solutions, right? Like say, for example, earlier the Xerox machines, they used to sell it based on, buy even a printer. You could buy a printer and say, okay, I spend so much per printer, or they can sell per page, right? So it's leased out to you, and depending on the number of prints you take out, you can pay. So that's a different business model. So that's where when you look at profit and revenue and expenses, the pricing becomes very important to understand what's your business model. So, there are so many variations. What I would suggest is keep it simple at the start. Don't overcomplicate, right? And look at what makes sense to you. Because if you have too many complications and too advanced a model, it may not be worth the time and energy, and ultimately you don't even know if you're going to benefit with that. So the other equation is this is the balance sheet equation. Your stake is equal to the assets minus liabilities. So I'm not going into a detailed accounting and finance session, right? This itself will take a long time to explain. But broadly, what you need to understand is what you own. Assets are what you own, and assets are what you owe others. So there are, activities there, which where you look at your assets and liabilities. So these are the two equations: the profit equation and the shareholders equation. And I will show you the 3 financial statements here. So the balance sheet, which is what I was talking about, it tells you about the state of affairs of the organization. And that means basically it tells you your position at a point in time. So over a period, if you look at your past few balance sheets, you will see how you're progressing. So on one side, you will show how much money you've raised, right? The source of your funding. And the other side, you will show how the funds are being used. So whether it is used as, there are three elements in that balance sheet. So you have your it's used as a long-term asset, right, which is your land, building, vehicles, right? Then you have another kind of assets, which is your short-term assets, which is your working capital, which could mean your stocks, your finished goods which are not sold yet. Then money, which others owe to you, and money which you owe to them. For example, if you're purchasing something, you've purchased some goods and you've not yet paid for it. So then that's a liability, right? Similarly, salaries. So on the 31st of the month, if you don't pay salary on the 31st of March, but you pay it on the 5th or the 10th of April, so you will be showing, let us say 20 lakhs salaries is owed to some people, right? So that 20 lakhs will show up in the balance sheet as money which is owed as salaries. So it's a liability. And so you have long term, the assets, and then you have the liabilities which are which are due, so current assets and current liabilities, and then you have investments which show up, so subsidiaries or other units, etc. So that shows at a period of time, and it could be any date you drop the balance sheet, you understand what is the source of your funding, what you own, and what is the money you owe others, which could be long-term or short-term. Long-term could be like your loans, which you take up from the banks, etc. Then we have something called a profit and loss account, which gives you working results for a period. So the given period could be monthly, it could be quarterly, it could be annual. So basically the profit and loss account will detail the operational expenses and income. So what is the revenue you earn and what is the expenditure, that shows up in the profit and loss account. And then we have the cash flow statement, which talks about the money flow, the cash flowing in and out of the business. So for example, when I talked about salary, right? The cash flow on say 31st March of a year will not show salary paid out. So the cash flow in March will not show salary, but the cash flow will be showing in the April statement as paid out. So it actually tracks the way the cash is going. Similarly, if you buy something on installment, right? So if it costs say 10 lakhs and you're paying 1 lakh a month for 12 months. So then effectively what happens is, if you're paying that for 12 months, you're paying out 12 lakhs. Out of the 12 lakhs, the cost is 10. So the cost of the material is 10 lakhs. The 2 lakhs is the interest you've paid. So it has, in accounting, it has to be accounted separately. And just coming to the 10 lakhs in the installment, it will be showing out paid every month. Whereas actually the purchase cost may be 10 lakhs, which will be showing in the asset as machinery purchased. So this is where, of course, today the computer systems and software takes care of it, right, of the accounting. But broadly, if you're seriously trying to understand as an entrepreneur, it would help you to get familiar with some of these basics. It may be time consuming. You can give yourself a target of a few months to understand, right? And you can take classes online or work with a book, read up, so that you get familiar with these terms. And tomorrow, if you're looking at a long-term being in the space as an entrepreneur, it would help you to understand some of these terms. So when you're looking at this, it helps you to, as a business, it helps you to think through your business and strategy. You look at your pain points and develop your financial model over time. Again, when you look at financial planning, right, we'll talk of three terms. There's a short term, there's a medium term, and there's a long term. And you as an entrepreneur will have to balance between the two. So one point I suggested to you was take time out to understand the finance. The other thing which I suggest is take some time to balance between these three. So usually what happens is we are so busy firefighting, looking at the day-to-day, that many times entrepreneurs do not think about the long term. So you could carve out some time, say maybe once a quarter, just to see, is the trend moving towards where you want it to go? Or maybe like, there was an event like the COVID situation, right, where things completely changed. and you have to reset your long-term goal and thinking, and you have to redo probably your business model. So these, then survival becomes important. But even in that situation, looking at where are you going. So spend some time looking at where you're heading and resetting. And think through your requirements of cash and valuation. So I will talk a little bit about funding. Just before that, when you're putting your, a plan together for your forecast, right? Especially when you're looking at funding and trying to understand, where do I need money? Do I need to raise 1 crore? Maybe 1 crore this year and 5 crores next year if things go as planned, and then 25 crores in the year after. Then how do you actually, plan for that? How do you build a forecast? So two tools which are used are sensitivity and scenario analysis. And I will share the spreadsheet for scenario analysis, and where you look at saying, let me look at that and show it to you. 1 second. I will just pull out my other sheet. Just a minute, I'm stopping the share. I'm pulling out a spreadsheet now. So this is a scenario analysis. You can see this, right? So if not, please let me know. So is there another chat here? Okay, so there is this revenue, right? If you look at a scenario where the optimistic scenario is there, we are talking of 24 lakhs in year 1. And in the pessimistic, we're talking of 16 lakhs. And in year 3, now this 24 goes on to double it, more than double, and then it becomes 1 crore, 12 lakhs in the 3rd year. Whereas in the normal scenario, it goes from 20 to 90 lakhs. And the pessimistic scenario, it goes from 16 to 63. So if you look at 63 in year 3 in the pessimistic and year 3 in the optimistic, it is 1 crore 12 lakhs. So you see the difference, right? So this is how you look at the various scenarios. You can build it up, and then of course these are based on monthly, and like we talk of how do you build? For example, how would you get this 24? So one way to look at it is to look at revenue in terms of categories of customers. So let us say we have A, B, C, D categories. We talk of current revenue with current customers, right? So if you have existing customers bringing you 5 lakhs, then you talk of 5 lakhs existing. Now you expect the same customers to give you more revenue. So you expect them to say it'll go up by 50%. So your 5 lakhs becomes 7.5 lakhs. Then you talk of new customers who are in the pipeline. So if you're talking to 15 people, you may expect 2 or 3 of them to convert. So what is the name? What are the names and what are you getting? And when I'm saying list the names, these are the questions which will come up in due diligence. So you have to justify, okay, these are the current contracts which I have, which I'm getting 5 lakhs from. Now my additional revenue is coming from these existing customers. I've been talking to them and they're going to give me double. They're very happy, right? And 1 or 2 are going to keep the same revenue. So you will actually go few critical customers, depending on how many you have. If you have 1,000 customers, obviously, when the due diligence is done, they're not going to look at all the 1,000. But if you have 4 or 5 critical customers, they may look at it and say, okay, these guys are happy with you, right? Just like you look at the rating, customer ratings, right? On when you go online for e-commerce purchases, they will look at the customer's feedback to you. And then if you're talking of, say, for example, year 3, right? In this case, optimistic year 3. Now, here, I highlighted it with a different color, right? How will you get these? right? So this 1 crore 12 lakhs 50,000. Now it's going to come from some new customers, new category, right? From it all of them obviously will not be coming from the existing. So some of it will come from this. So you may have a list plus others not in list, right? Partial list. So this is where you actually justify, if you're going to an investor or talking to anybody, this is how you actually come up with the numbers, and you talk of this 24, 54 through that category. Another way is to look at revenue stream 1, revenue stream 2, right? Or you can look at, say, product 1, units sold, solution sales. So depending on your line of business and the way you do it, this is where, when you're doing your projections, you actually get into the details of revenue, right? And then you build it up and you look at the 3 scenarios. So this is how I'm focusing on revenue, because that is the critical element. Many times from an investor perspective, if you satisfy this, then you can say 80% of your due diligence is done. Okay, because due diligence typically, especially in a startup and early stage business, is focusing on the growth of the business and revenue generation, right? And if you can convince people that your assumptions are well thought through with integrity, right? You're not bluffing your way here. And they will, of course, if you're an existing business, look at your past track, saying, okay, can you genuinely say that you can do this, right? Whereas in the past, if you projected you will do 50 and you've done only 20, okay, unless it was because of unusual times like COVID, that then you came back and bounced back, that's a different matter. So you have to actually convince people. So this is the forecasting exercise which you may most want to focus on as entrepreneurs looking at growth and next level phase of your business, if you want to get into that, right? So now I will stop the share and come back. Okay, it stopped, and let me come back to this. Yeah, before that, I'd like to pause here. We are almost halfway through, and just take up any Q&A till now, if there's anything, before I go to the next stage. Right, the next stage is going to focus a little bit on finance. Yes, Vartika.
Yeah, hi, good evening, ma'am. Ma'am, I just want to know one thing. What is the significance of profit before tax and profits after tax?
Yeah, so significance in the sense, one is your profit which you get, which shows the business operations, your capability, right? And the real profit which is available is after tax, right? So your profit before tax shows how efficiently you're running the business to generate profit, and that will be compared with the market, right? In your line of business, if others are getting 20% and you're getting only 10%, right? Or if others are getting whatever 10% and you are doing 12%, then people, the investors or anybody looking at it, right, even your auditors would like to understand, how is it you're showing 12% and you're showing more? Is it because you've been creative in something or outsource something, or is it because there's some wrong number somewhere? Is it an error or a intentional mistake, okay, or is it a fraud? So things like that, so people get an understanding of your business and in position with the others in the market in that same industry, right, or similar industries. Whereas after tax is, it's regulatory, right? And that is the real number which is available to you. The money before tax is not available to you. You have to pay tax, right? So that's the difference.
Okay, ma'am. Thank you so much.
Yeah.
Yeah. So Anjana, you just mentioned 10%, 12%. So are you talking about 10% of revenue?
Yes. Okay. That's sometimes we have to explain it properly. So I'm sorry I missed that. Yes. Usually we talk of percentage of revenue. So when we look at profitability, it's seen as a percentage of revenue, right? What's the margin? So operating margin. So there's something called a gross margin. Like I said, in a 1 hour session, I'm not able to really get into depth, right? So we look at the business finance, when we talk of it, we talk of sales minus the operating costs at the basic factory level, which is your gross margin. And then you have your sales and administration costs, and then you have the other the actual profit margin, and then you have your tax, and so you have your profit after tax, right? So we have something called the before depreciation, before. So there are a lot of layers at which profitability is analyzed. So if you look at professionals, they will talk about that, right? And these are actually based on the revenue number. And so even revenue, gross revenue versus net revenue, that's another thing. So the gross revenue will be, say, if you sell something for 100 rupees, that's the 100. But they sell it on discount. So the net revenue, actually the items sold. So they may sell some shirts to you. The actual price may be 1,000, but the discounted price is 900. So the net revenue is 900, not 1,000, right? So there are different levels of revenue which are looked at, and you may see that depending on your industry. I know Vartika has raised her hand again, but I will respond to you later, Vartika. I'll come back to you later if there's anybody else with a question.
Sure, ma'am.
Thank you.
Yeah.
Thank you, Anjana.
Yeah. Anybody else? I have some couple of chats which have come up. Some questions there. Cost of goods from service versus manufacturing. Yeah, so in service, in cost of goods sold, in the nature of the cost would be different in manufacturing. So typically in manufacturing, you will have raw material, factory costs, etc. Right? Whereas in services, you may have salaries for different levels. So you have to actually distinguish between salary for sales and administration versus salary for production, right? For product development or for delivery, right? So if you just look at it, like I was telling you, there are elements. So you talk of revenue versus the elements of cost for delivering that revenue in the service. So if you just look at the activities, if you look at what I've said in an earlier slide, I said, break down into the activities and plug the costs into the activities. So service delivery could be, you may also use a tool for delivery of service. For example, if you, in an accounting office, right, they use Excel, say, for delivery. Tally is used for delivery. So some of those costs you may have to apportion also. So it depends on, I'm just giving you very generic examples, right? It depends on your line of business. So you break up the activities and look at the costs there. Whereas in manufacturing, it's more straightforward because it's like raw material, it's a factory cost, it's running the factory, right? And those costs will differ. So this is at a very broad level. And yes, if there's any other question, otherwise I'll take Vartika's question and then move ahead.
Yeah, can I go ahead, ma'am? Yes, thank you, ma'am. Ma'am,
Yes,
what
please.
is your recommendation? How frequently we should run this exercise of forecasting? Like monthly we should run this exercise or annually?
See, typically forecasting is a annual exercise, right? So you have something, maybe what I will do is I will also send you some sheet which talks about the MIS. When I talk of the MIS, we talk of doing it on a regular basis. I will come to that a little later in my last bit of presentation today. But what you do is you forecast on a regular basis, monthly, right? The exercise is done annually, but you do it, say, over the year. Saying January I'll have, or whatever, April will be so much, March will be so much, right? You can say I'm selling 10 units in March, in April, 10 in May, 11 or 12 in the next few months, etc. Till the end of the year, I double. My run rate is 20 units per month, right? By next March 31st. So you actually look at it on the whole annual basis. So for the whole year, it is something like 200 or so based on this monthly basis, right? And so what you actually need to do is every month come back and see the real number. So middle of May, you may have April numbers. So if you said 10 in April and you've only done 11, so you may think that, and you've only done 8. So you may like to reset the number 200 and saying, I may not be able to reach 200, I may be able to reach 180. Or it may be the other way around, saying, I've actually done much better. I think I may do 250, right? So you look at it through your MIS on a regular basis, monthly basis. And it depends on your line of business again, right? There are, and how frequently your sales, for retail, for example, they may look at it weekly. Cash is looked at weekly, daily, right? So it depends on the item which you're looking at and the nature of your business. Yeah. So, okay, I think with that, I will proceed because we have about a half hour now. So use your templates, like I said, the spreadsheets, and just I think Vartika was asking if you have the spreadsheet, if you have links, for example, if you just are relooking at the numbers, if you say you've done better or worse, you can change the percentage in the spreadsheet and say instead of saying a 10% growth every 2 months, you can talk of 12% or 15%. So by plugging in something in the assumptions, you can change the link. The output will change. So try to build an intelligent spreadsheet which you can reuse. Then, okay, now is where I'm talking about from investors' point of view, from the business point of view, looking at growth. So when you're looking at growth, you would be looking for money. And are you seeking money now? Or can you bootstrap now? Can you generate revenue if you don't get money? So what are the kind of options which you have before you, right? And who are the kinds of investors? There could be, angel groups, there could be seed funds, accelerators, online platforms, etc., etc. So I'm not going to run through this list. This is just a generic list, and you can, take a look at it and see what works for you. So from an investor point of view, they want to see a team which can execute, right? Like I was talking about earlier, whatever projection you've done, the assumptions you've done, when they question you, they will understand whether you really mean what you say, whether those numbers are achievable. Is that market high? Does your team have the potential to address it? Do you have the ambition to address it, right? Are the risks there? Is the competition set out, etc.? And then there is a fit for them, the investor. Do you fit with their fund philosophy? So, this is what happens. There was one company which was invested in by a social entrepreneur, okay, impact fund, you could say. So they were in the line of business of actually providing some service. I don't want to get into details. So in that service, some of it was going to making an impact on certain low-income groups. So they said, okay, this is a business which is going to impact and help low-income groups, and so we will fund it. So it was a business model, financial model, service business, but impacting and addressing low-income groups. So the impact fund invested in this. Now a regular fund, it was actually a good business, but a regular fund came in and said, oh, this impact fund is invested. So, though it's a great business, the impact fund will look for something different, and they will not bother if it's not so profitable. Whereas we are very aggressively wanting returns, financial returns. So just because that impact fund had invested in this business, they backed out of it, right? They said our goals and the impact fund's goals do not match. So they don't fit into our, they may not fit into our way of thinking. So the deal was dropped. So sometimes when you're getting into investment, please look at the long term. Where do you want to go, right? And of course, what investors seek is multiple things, right? But basically, they're looking to see if there is a business, there's a market, and your team can deliver it, and you have some strategy in place to achieve that. So then there is also some due diligence which is done, and I talked a little bit about the due diligence. So I'll get into it a little bit more now and give you some examples. So what they do is, there are different aspects they look at. So the business aspect, the technology aspect, the legal, the finance, right? And some of these, like the legal, the tax, etc., is outsourced. Some of this may be done by the investors themselves, like to understand business and markets, They may have some teams inside to understand the technology. So this is where I'm giving you some examples. So here there was a forecast which was not given by the company, and when you do the forecast, these are the things you have to pay in mind, keep in mind when you are trying to build a forecast for somebody, to show to some investor. So for example, they had 31st March, they said we are in one city. Okay, then 1st of April, they said we're in 8 cities. So, Vartika was asking what monthly projections, right? So monthly projections were shown for a few years. Now, in 1 year, suddenly from 31st March, the next 1st April, they showed 8 cities, which is logically not possible. You cannot, in that business, it was not possible. So in one day, from 31st March to 1st April, you cannot have that jump. So the business was just doing it as a math. The forecast was done like a mathematics projection, not like a business projection. So I hope you understand the difference. So when investors look at the spreadsheets, they expect the spreadsheets to talk to them as if the business is talking to them. So the numbers have to reflect that. So then, it was not that there was any intention to, deceive anybody. So they just told the management to go back and reflect the true picture. Then there was another service aggregator. Okay, this was where they were showing the the revenue accounted for on receipt. So for example, February they had received 5 lakhs for a 1 year service contract, and they showed the entire 5 lakhs in February as income, whereas that 5 lakhs income would be available, only part of it, say 50,000 was for February and March. The balance 4,50,000 relates to the next financial year. So the balance 4,50,000 should not have been accounted for in this year's income. So similarly, there are other points. So I'm not getting into all that. So just to give you an example of how when you project and forecast, investors will start looking at it carefully. So when you're looking at your business projections, this is where your professional help is also important. You can do it yourself, but some of these, there are some accounting rules and regulations, just like law has regulations, right? So in accounting, there is some generally accepted accounting principles. So based on these guidelines, which are global, some of these are global, few are startup specific, few are India specific, right? So you really need to understand that you're following these guidelines. When an investor is coming, they will want to see that you're following these guidelines. So that's where the professional help is required. And if you're in business, if you've been in business, as I guess most of you have been for the past few years, you will have your financial statements, which they will look at, right? Your auditor would have prepared it. So that's another basic check they will do to see if those are showing numbers correctly. So here what advice was given to the management was to relook at some of these numbers and look at pricing strategy, based on which only the next bit of money was to be released. So here money was not released. So they had some, about 1 crore committed as investment, out of which only 50 lakhs had been released. The next 50 lakhs was to be released after this midterm due diligence. And it was not done. They said management should go back, relook at the numbers and come back, and then they would see if the balance money could be given. So in another case, there was a project which was looked at, and just like I told you in that forecast example, where there was a category A, B, C, D. So they had the company, the entrepreneurs had actually listed out what is the categories of segmentation and the probability based on past record. And the domain knowledge and expertise was demonstrated. So, for example, these were in the food business. So they knew, I talked about fast food and fine dining. So they knew all about it, saying these are the kind of foods which are popular. So breakfast time, this is popular. Lunchtime, this is the percentage of beverage which gets sold. Dinner time, this is the breakup, right? These are the kind of meals which go, and the various types of items which are popular and not popular. So they really knew the business in and out. So, and they were setting up a chain. And they said, okay, this is in the North India, this is popular. In South India, this is popular. So they had some 3 or 4 restaurants across the country in a couple of states. So they knew in and out about this. And so the investor was comfortable saying, okay, you want to expand into a few more in this chain, in these areas, in these regions. Okay, you know about it. We can give you, we can try to fund you. So that was how, it was in that case. Then this is coming to your, measure, analyze, and reset, which is what the questions were coming around. How do we measure, and how do we, do we forecast on a regular basis? So the individual, we as an individual, we measure height, blood pressure, sugar, right? Cholesterol levels, etc. So what are the lines of measures for your business, right? So we look at capturing data periodically. It could be monthly, fortnightly, weekly, depending on your line of business. Then you look at the key value drivers. What are the value depleters? So this is basically, looking at saying, when you say value drivers, your customers, right? What are the key customers? And you can even get into, say, a quality of customers, saying, average revenue per employee, number of customers. So if you're tracking, say, number of customers in each state. So if you're very focused on building customers in India, so customers in South India versus customers in Middle India versus those in North India, right? If you want to have a regional focus, then customers who are above, whom we are selling to more than, who buy more than 10 lakhs. So 10 lakh value customers, the big corporate stock of $1 billion customers, right? So this is one classic thing. Many of organizations like to look at the big high value customers, and then you can actually focus on them and see what can we do to retain them or make their experience better. Losing customers is another very important thing. And why have the customers not come back? Why the footfalls not there, right? With the pipeline customers, so if we have 100 people who've inquired, are we able to convert 10%? Okay, in the previous year, we could convert 15%. Why has it dropped to 10%? Is it because we have slacked, our business quality has reduced, or delivery quality has reduced, or is it because competition has come, right? So some of these could be internal and help you judge, look at internal issues, and some of these could be external issues. Now, and as I mentioned this before also, when you are looking at all these, look at it critically, but don't overthink. So, you don't have to look at hundreds of things. Look at 1 or 2 critical items and then analyze it. Or you can even take it in turns. Like, say, 1 month, you can focus on the sales. The next month, you could focus on the costs. The third month, you could focus on, say, employee satisfaction, which you again measure looking at, saying how many employees have joined, how many employees have left, right? So it's not just about items which are in accounts and finance, which you measure, but even things like this, saying employee turnover, right? How much now it would be even like how many employees work from home versus how many employees are willing to come to work from office, right? Things like that. How much is productivity impacted? Etc. etc. Some of these can be questioned and looked at. So you can take each one of these and look at it for a month, and then put some things in place. And I do understand, as entrepreneurs, you have limited time, but at least spend a little bit of time on this. What happens is, many times entrepreneurs do not look at analyzing and evaluating and thinking. So one of my old bosses, he used to tell me, this was like 20 years ago, okay? And he had told me this. He says, Anjana, you should spend 9 minutes thinking, 9 minutes in thought, and 1 minute in action. Okay, that was the formula he had given me. And I have been trying to practice that for the last 20 years. And I think it's made a difference, because today I'm, sitting before you, okay, and I should share this with you. I'm now a grandmother. I'm playing part-time duty as a grandmother, to twin grandsons. They're 3 years old. So I have to manage them, as well as now I'm, doing this session for you at 60 years. So I think, I'm managing to balance both. So it's not like I'm just saying that you should do this without experience, right? Having been an entrepreneur myself, I see the value of thinking and analysis, but over analysis is not good. It is not worth it. So you will figure out once you get into the habit of thinking and analyzing, it becomes second nature, and you will succeed as a business much more than you would otherwise. This is my personal experience, of course. I hope it turns out to be the same for you. So there are more illustrative parameters which you can think of, which I talked about. So the key expenses, number of employees, your receivables, and these are some examples which I have given you. And you can figure out what makes sense in your business and what are the key value parameters for your business. So just in summary, you please design this with care, because too little information is not helpful, as well as, too much data can be counterproductive. And look for your patterns and trends. This is the small data. It's not a big data analysis. Nothing like putting your own eyes and your mind to work. Of course, despite having the tools, nothing like that, thinking for yourself. And what you need to do with the data is check for variances. So understand why the variance is coming. So I gave you the example earlier saying, maybe the conversion, right? You are in the previous year, if you out of 100, you could, or previous pipeline, out of 100, if you could convert 10. And now, if you can convert out of 100, only 12, only 8. So there is a drop of 2%. So is that drop because of a problem with your business? Is the drop the underlying cause? Is the underlying cause something external? Or is it just the nature of how it is, the quality of the pipeline, right? So spend some time thinking and looking at why the variances happened, compare with other companies, competition, and redo this and refactor it into your business forecast and future plans. So in summary, this is very critical way of thinking, because many people think that if they had money, they will be very successful. And if they don't have money, they cannot be successful, which is totally not true. You yourself have examples in front of you of those who didn't have money, right, who are not funded, who succeeded. But it is true, money has its space. It is important for all of us. It does give us some energy to go ahead. So not denying that, but don't assume that all success is only coming because of money. So that's one takeaway I want to leave at the end of the session. And wishing you all the best. I'm opening it up for questions so that we can customize it more to you, your requirements, and then I can share some other stuff if required. So let me stop the share now and open it up to Q&A. Any specific questions on accounts, finance, numbers? I'm not saying that I have all the answers, but I can try.
Akhila, please unmute and ask your question.
Hi, ma'am. Wonderful session. My name is Akhila. I'm trying to represent Test AI NG company behalf of all the founders who are part of that organization. We are into artificial intelligence company. We are a startup company, and it's been 3 years that we are into market. And our founders are really trying to get in touch with investors, and they're trying a lot for the funding option. But I'm not sure till today that we have not been funded, and the balance is it's showing negative, and all the founders are in a position that soon, if there is no coming back to the sales, there's no sales. Meanwhile, there's no funding, or the investors are also not showing interest. But it's one of the different product that we are selling it out in terms of technology.
Brief. I mean, is there anything specific you want to add, or? Yeah.
Yes, ma'am. So I'm trying to know what could be the, are there any tweaks that we should do in order to get of investors' attention, or how is it?
Okay.
Like,
So,
is there a standard script?
right. So if you look at investment, out of 500, I mean, this is a very generic statement I'm making, depending specifically on the industry, right? Out of 500 companies, one will get funded, right? It is not easy to get funding. Like I said, this is just a very standard number. Depending on your industry or your stage of business, it may vary. But even then, it's not easy to get funding.
Okay.
What the investor wants is a guarantee, or at least on paper, it looks like there is a reasonable chance that your business can grow. So if they put, say, 10 rupees in a share, they want the 10 to become 50 or 100 in 3 or 5 years. Okay, that's the math for them. So if your share price has to go up, what it means is that the business has to jump in value multiple times to reach that stage. Now, do you have the potential? So it starts with two things. One is internal to you as a business. Okay, do the founders, does the product have that potential to reach? But more importantly, is there a market out there, right? So how will you create the market if it doesn't exist? So if it is in a new line of business, it's difficult to kind of build that. And it takes a very long time. So, they have, like I said, 500 companies to choose from. Why will they come to you then? If you're not able to provide, you're saying revenue is not there, right? So how then can you demonstrate that the value will come? Because the value will come only if you have that growth. So you have to demonstrate the ability to grow. I mean, this is a very generic answer. Till I look at your business, I cannot specifically say this is the reason, right? This is the lack, right? This could be the flaw. So,
Okay.
right? But it's a very, it is not easy to raise funding. You have to demonstrate that you can grow and you'll have the capability to grow. Which it seems from what you've said, it's not so easy to prove.
Okay. Sure, ma'am.
What I would like you to do is also, if you wish, talk to, get a mentor from, Thai to look at your case, business case, and see specifically if there's something you can do. Or otherwise, then you have to say, okay, funding will not happen for my case. I have to alternate. Right? Not every company is suited for funding.
Right.
It may also be that.
Makes sense, ma'am.
Because like I said, out of 500 companies, only one can get funded. It's not that all 500 do not survive. Some of them may survive without funding. I mean, Infosys and all grew only through debt. From the Karnataka government, KSFC, I think they took a loan. And their customers. Right? Of course, it was then. But not every company grows to be where it is through VC funding. Okay.
Got it, ma'am. Yeah. Thank you so much. Yeah.
And request that people make the questions brief and to the point in view of answering. There are some chat questions. I will come back to that. If there's anybody else, Kanchan.
Yeah. So hi Anjana, that was really, really useful. Thanks for that. So mine is a fintech into lending, and I was looking at, yes, it's called Loan Genie. So so I was trying to understand that at a very early stage, is our revenues more important, or is are the investors going to be looking at profitability? That was the first question. And the second question was around in this environment of when the people are talking about long winter and to be a camel and things like that. What are the ways that you can look at your spreadsheets and cut costs, and which are the key heads under which you have seen cost cuts being made, where typically people tend to overspend? And I think you mentioned rent as one of them, wherein one of the founders, they actually had put it up for a lot of rent, and they were hardly making any sales, but a lot of money was going into the rent part of it. So I was looking at what are the ways you can look at bringing down your bottom line, and also
Okay. So, yeah, so I'm just trying to keep it brief so I can answer as many as possible. So the thing is, from your business or businesses which are looking at growth, see here there is a balance between profitability and growth. So I think in such cases, investors look more for growth. But if you can convince them that profitability will come, your business model has that built in, rather than saying, okay, advertisements will come at some point, this will happen at some point, but to show there is some sight of profit, right? And this is for everybody. When you're looking at revenue traction and customer acquisition, you may not look at getting significant profit now. Rather, it will be a loss situation, right? That's okay, because that's your business model is like that. But at least in 3 years or 5 years or whatever, right? And I would not like to push it beyond that, but at least in 5 years, can I say that I can get there? And how will I get there? Can I demonstrate that? And if you can convince somebody that it's possible, then they may take a bet on you. It's ultimately taking a bet on you, right? That is one. Yeah, and cost cutting, what I would suggest is look at each and every element, right, of your line item of costs and see where the big costs are coming from, right? So rent is very straightforward. The other is, like I said, being innovative in rent, even things like capital costs. So there was this lady who was trying to sell chocolates, right? And this was in UK. She was making chocolates, and she needed to buy a lot of equipment to molds in Christmas time to make more chocolates. So what she did was, instead of getting the molds, she gave out gift coupons. So, her existing customers got a discounted coupon and they gave it to a lot of people as gifts. So in advance, she collected the money. Okay. And with that, she could buy the molds. So she was a little innovative. And so that is where I would like you to think, and as entrepreneurs, be creative about where you can raise money, not in a wrong way, creative in a right way. And because accounting creativity can come with its own lack of ethics. But that's where I'm pushing at, looking at your financial model and business model. You can really innovate there. Like the company innovated with rentals, giving it as a percentage of sales. Then your costs are not linked to cash outflow. It is linked to sales, right? So I think one is to look at your elements, like say revenue is high, but if raw material cost is high, can you say, okay, on a just need basis? But sometimes you may not. You may get, especially with the chips, etc., right? In bulk, if you place the order, you get huge cost saving. So it's a very difficult decision to make. And the other thing is also the mindset of entrepreneurs. Some people are willing to risk everything. Some people are not willing to risk. So your risk appetite depends on your capability and your inclination, right? Now, I think I'd just like to look at some of the questions which are coming up on the chat. There's a B2B SaaS wanted to understand for a seed round. Okay, so when there's a startup with not too much happening, from a seed fund, okay, it's not really about the business. It's more about the people and the ability to penetrate. You have to demonstrate, again, like I said, the ability that you can penetrate the market, you understand the space, and there is a market, right? There's definitely a market. So then the focus is more on the entrepreneurs and the capability of the entrepreneurs and less on the business. And so you should take a smaller seed round and not give away too much, right? I mean, these are just the two bits which I can think of. Again, like I'm saying, my solution is very basic. My points are very basic here because I really don't know too much about the business. I'm talking at a very 10,000 foot level, right? Specifically, when one looks at your business, there may be something else. But in general, when there's a very early stage funding, it is more about the people and less about the business. As you go down, it's more about the business. And as you go later, it's almost all about the business, right? Depending on which stage you are. And so the past record of the entrepreneur becomes important. So for example, if you've been an employee in a company and somebody says, yeah, you're very dynamic and you are a high achiever and you will succeed. You are determined, you're pig-headed and you want to succeed in the right way, right? Again, I'm talking about ethically. That's very important. Please note that. Not in, just at any cost. So if some, senior of yours or your manager asserts that you have that capability, then that capability you bring to the business, that may also give you an edge over somebody else, right? And so the valuation multiples, I don't want to generalize about the multiples. I don't want to give any multiples because again, it is very, very dependent on the stage of the business and the kind of business, right? Specific business. So there's no general number I can give. And typical valuation criteria for B2B startups is, again, same thing. How do you, your customers, who are the businesses you're selling to? Why will they come to you and not to others, right? Understanding those, what are the value drivers for your revenue? Competition, it comes back to that. There are only 2 or 3 critical parameters. It's about sales, customers, and your ability to sell and address the market, and competition, right? So one is what can give you the upside to revenue, and very simply put, right, there is something which pushes your revenue. So what can push your revenue and what can pull down your revenue? Can you address that? How can you address those things which will, the risks? So look at both the upsides and the downsides. Internally to you as entrepreneurs, what can you do as a business, and externally the ecosystem. So just look at it from those parameters. That's one part of it. Then ESOPs allocation, again, somebody's asking. It varies depending on the mindset of the entrepreneurs. People vary from say 5% to even 20%, right? Maybe a 12 to 15%, because ultimately that 12 to 15% is a number, right? Or you can start off with 5% and then increase the allocation later, because whatever you allocate, it's an allocation. The reality is what you give, right? So line of business, again, what's happening in the industry, in your competitive space. If somebody else is allocating 15% and then you say, I'm going to give 5%, then you may not get potential employees to come, right? So it also depends on the ecosystem around you. Yes. Any other questions? Is somebody here trying to?
Yeah, Anjana, hi. This is Rahul. Yeah.
Yes.
This sort of valuation, in fact, that question was posed by me. So
okay.
Would you think that the general macro environment, especially over the past 6 months, has
okay, I missed this question.
Right? Like SaaS multiples have fallen off 60, 70%. The
Yes.
Nasdaq itself has fallen by 30, 40%. This morning I saw in the paper that I think VC deals have fallen by like 40% or so in the past couple of quarters. So from that perspective, isn't it true that it's not probably the best time to look at raising funds, given your past experience, or do you think that that's not particularly true, that you can actually go out there and raise based on the strength of your own business and so on and so forth?
Yeah. So I think that's an important question, because see, if you are looking at external, okay, the market has dropped, but if you're it is a good time to raise money, and there is always money out there. Okay, it's not there is never a wrong time if you get money, but depends on, if you're looking at the same valuation you were getting before, you will not get it. Unlikely. Right. Very, very unlikely, unless there are exceptions. Okay, if you were sitting on a great business and there's see, from an investor point of view also, everything has fallen. They have money, they may want to invest, right? So they're also looking for good cases, just putting yourself in the investor's shoes. So if you have a great business which has high potential and is very exciting to them, they would love to invest.
Right.
So that is one aspect. But if you could raise something by giving away 10%, you may have to give away 20% today, or 15%, because I'm actually saying 20% rather than saying 15%, because if large corporates valuation has fallen by 30%, the startups valuation will go down by 60, 70, 80%, right?
Yeah.
So are you prepared to give up so much? Because notionally you would not have been prepared. It's a psychological problem. Right? So that is one part of it. So are you willing to accept money for giving away more stake? So it's up to you. So then you have to rebuild your financial plan for the next 5 years or 10 years to your exit and your dream. right? So that is one part of it. The second part of it is it's always good to build a business in the downturn, because you are prudent. You will not throw your money and be subject to waste in building your business. You'll be very careful and tight.
Right.
You'll be prudent. So it's a good time to build a business. Downturns are always good for building a resilient business which will survive and sustain, because you will take care that you build a sustainable business. So in that point of view, yes, it's good. It's a good time. Yeah.
Right.
I'm giving all generic answers, and I hope that helps.
That's fine. Thanks. I wanted to get a perspective on that, because I'm sure you've seen like multiple downturns, and I think we're going through one as we speak. So it would be useful.
I qualified in 1986 as a chartered accountant.
Yeah.
Okay, and I've been teaching entrepreneurship since late 90s, teaching about venture capital in the late 90s. Okay, so I've seen a lot. Yeah.
Thanks a lot, Anjana, for sharing your perspectives. Thank you.
Welcome. Yeah, there seems to be one more question here. I think that's about it. Yeah. Okay, we are on time now, 9:30. I mean, for me, 9:30 a.m., which is your 7 p.m., I guess, right?
Yes, right on the clock. Thank you so much, Anjana. Thank you.
Welcome. And thank you all for making it a very interactive session. I enjoyed. I always prefer questions to speaking.
Thank you so much, Anjana, for being here and sharing your knowledge. I'm sure everyone is going with a lot of takeaways. And so I will share all the stuff that you will be sharing with me. And last year's resource file is still being used. So I'm sure it's going to go a long way. Thank you so much.